Hi everyone, I'm Cullen Haynes and welcome to Lawyer Lending Live. My next guest has had over 30 years in both the property and banking space and probably one of the only buyer's agents that has had experience deep in the realms of HSBC's data-driven property team. Would you please make very welcome one of the directors of real property buyers, Mr. Michael Salvartsis. How are you there, Michael? What's going on, sir?
Hi, Cullen. How you going?
All the better for hearing you, sir, and seeing your face, mon ami. I want to ask, what is happening in your circle of influence? What's the latest?
Yeah, look, we're really busy, Callum. So basically, we went through some RBA changes, and I think since the changes started to come in at 0.25 rather than 0.5, it's created a bit more momentum and confidence out there.
That's good.
So from our point of view, we've got good active briefs, we've got good pipeline, and we're starting to see, a lot of momentum. And also, I think from a business point of view, we've got a growing business. Real property buyers is about 7 years old, okay, and our business is growing year on year, which is really good. Part of that component is an educational piece. So we don't just buy property for people. We also provide a lot of education. And my philosophy to real property buyers and business and clients is that you need to educate them along the process. Okay.
So I think that's really important because our clientele, lawyers, who the bulk of the people watching today will be, and I will say it's 11:03. If you've got any questions for Michael, please put them in real time. YouTube, LinkedIn, Facebook, we are streaming live. But lawyers as a demographic, our clients, having dealt with them for a number of years, quite skeptical, admittedly, and part of their job is to look at the rain clouds beyond the rainbows. So real estate agents, I know buyers agents are different, but real estate agents, they're quite skeptical at the best of times. So what you do and your team do are quite different because it is very much reliant on the data and what's happening rather than the facade, if that makes sense, of the property.
Yeah. So look, a lot of our client base, we've got a real mixed breakdown of clients. We buy for a lot of properties, a lot of clients who are time poor. A lot of them are medicos, and I say they're a lot smarter than me. Okay, so they are, but maybe not on the property side, but in every other thing, they're generally much more educated and they're quite rational type people. They're basically time poor. They just need independent advice and someone who can guide them along the process. Okay,
I agree.
Something that's really exciting for us is that we're a corporate sponsor. We've just taken that for Women's Network Australia.
Okay. Oh, fantastic!
Yes, about 30,000 members. It's a national networking base. We're I think we're actually the only male corporate sponsorship there. And it's something that's a national, that's strategic. And the reason that we've supported this, and this is something that's pretty close to me, is because, sometimes when people go through circumstances that are, whether they be a family law or whether they be passing of a partner, there's some overwhelming decisions that need to be made. And part of that is the property piece. And part of that is, I've got some sort of component of money. I now need to go and find a property for my family and for myself, and that process is very overwhelming. And a lot of the women that we do work with, they just need help, and we educate them. We make the process stress-free. We present opportunities to them. We don't push them or pressure them. And when they've come from difficult situations, we don't judge people, and we also show empathy. I think that's very important in that piece. Okay.
No, definitely. And I guess teasing out a little bit of your background, tell us a little bit more about your time at HSBC and how that, I guess, that is a great point of difference in the market of what's going on right now.
Yeah. So look, I went over to HSBC Bank when the book size was about $5 billion, right? The book size now, I believe, is about 30 billion. So they were a very niche bank many years ago. I went there and I stayed with them for about 14 years. they didn't have a property team. So I set up their
No.
property valuation, property risk team. I set up their
Yes.
systems, their processes. I was very actively involved in what the banks call acceptable security. I was very actively involved in property risk, so assessing
Yes.
risk. And when the occasional loans went bad, because it's a pretty clean book, but when the occasional
Yes.
loans went bad, I was very actively involved in providing receivers with advice on how to sell property to show due diligence and due care. So to maximise the bank's result, to maximise the client's result in very difficult predicaments when receivers are involved. Okay.
No, it can be a hard time.
Yeah, and I was also very actively involved in the bank's mortgage in possession matters. Okay. And what we did really well is that we did the agent appointment very well. The agents were accountable to us, and we made sure that we had a process. So if ever those files got subpoenaed because someone wasn't happy, they were ready to be viewed in the greater forum. So it's all about audit, compliance, following process. And I'm a firm believer that if you follow the process, the end result will be better.
No, absolutely. It sounds like you speak legal professionals' language because this is their day in and day out. They see the worst case of what can happen in their area of law. And case in point, Mina, who is a leading solicitor in his own right, says hello. So hello, Mina, a regular of the show. Thank you so much. But what's your take on the current market, Michael? What's happening, my friend?
Look, I'm what they call quite seasoned. Right? So I'm 30 years in the game, so I've seen a lot of peaks and troughs in the market, GFC, Asia crisis, stuff like that.
Yes.
The market is probably the most complex that I've seen over a few years. Okay. It's tiered, it's complex, it's tiered, it's geographically driven, and it's very price point sensitive. Okay. So when you look at, just to give you some context,
please.
Basically, when you look at, we've had about over 30% price growth from March 2020 when COVID started up until about November 2021. So when you have over 30% price growth, that's not sustainable. Okay. What we've seen is pretty much across the board a 10% price drop since then. Okay. So there's a lot of forecasts out there of property prices dropping further, but at the end of the day, remember, we need to take another 20% hit to bring it to a level that was pre-COVID levels.
Okay.
Now, I personally can't see that. Okay.
No.
So even if the market adjusts, which it is adjusting, basically we're still going to be ahead of the median prices that were available before we entered COVID. Okay. So that puts context around the way that we see the market and what we're seeing on the ground. Okay. In my opinion, we've done a lot of work in this space, Callum. For instance, I don't value anymore, but I've got a valuation background. I valued for about 15 years in industry, right, and for banks. And we've got geographically, the fall in prices is very different. The eastern suburbs was probably the first area that was subjected to price decline.
Yes.
Then it was followed by the inner west, lower North Shore, Bayside held up better, and then the Hills district. So markets don't move in the same direction; they don't move at the same time. Yeah. So basically, as I said, I've got about 12 examples of properties that have sold and resold since the peak of the market in October last year to today, and they are showing under $1 million, pretty much no change at all. Okay.
Interesting.
The price points that are showing pressure and adjustment have been between sort of $1.5 million to $4 million. Okay.
So getting up into the luxury price point is where you're seeing a little bit of a shift.
Yeah, but when you get up over the $5 to $10 million, you're not seeing too much at all because interest rates don't impact that market. It's more about global uncertainty, share market volatility. So if you're playing in the space under $4 to $5 million, we've got examples between $1.5 million to $4 million right across Sydney of properties that have sold and resold, and their adjustments have been between 5 and 20%.
Interesting. No,
Yeah.
I think what you're saying is very apt, because we had a client buy for 10.5 million recently, and we're financing that right now as we speak. And there was still competition for that property. So it went over that hedge you're talking about, over that 5 million. There's still people playing in that market, and I was surprised I was surprised actually.
Yeah, and I can tell you now, like there's a lot of transactions that happen between $5 and $15 million, and a
Yes.
lot of those happen off market. Okay,
Yes.
and there's also a lot more stock on market. And look, for me, during the GFC, Mosman was one of the hardest hit regions during the GFC.
Yes.
Um, and we've recently purchased a prestige property in Mosman,
Lovely.
and basically, there's no signs of stress in the prestige end of town at the moment. I think we've got to watch this space, and then have a clearer position on it. But I'll tell you now, when you're buying $10 and $15 million properties, it's not just what's sitting on the website, but there's also we get as buyers agents, we get offered a lot of off-market properties at that price point. Okay.
And I like how you honor the S. You say it in such a Richard Mercer love song dedications way. Mosman, not Mossman. Very anyone watching would appreciate it. I like it. I like your take on it.
So look,
yeah. Tell me more.
So look, our biggest inquiry, our biggest buyer profile. So we're buying for upsizes and downsizes, and
Okay.
I've noticed that the borrowings are nominal. Okay, so I'll give you an example. We've got a couple of clients at the moment. They're in different geographies, so they're not conflicting briefs, right?
No.
They've got $2.5 million in budget, of which $2 million is in hard cash. Okay,
amazing.
So they're in very strong positions, right? And then the way we're seeing the market on the ground, open houses are strong.
Yes.
Auctions are very hit and miss.
Okay.
If properties are set at current market levels, they will sell. If they're set above market levels, they will actually not sell, and they'll probably go through multiple campaigns. Okay.
Yes.
The biggest buyer inquiry we're getting is from investors, and let me tell you, if you're an investor, there's no better time to come into the market than now. And the reason for that is rentals have increased by about 10% in the last 12 months. Vacancy levels in Sydney are about 1.3%. Now that is historic low, because a balanced market where landlords equals tenants is 3%. Okay. So the queues that became queues to buy property now become queues to rent property. Okay.
Interesting.
And with pressure on prices, yields for residential investors are strong and they're increasing. And this is why we're seeing, we're doing a lot of work with investors, and investors most typically, their price points is up to about $1.5 million. And that's that segment that hasn't seen a lot of volatility.
No, it's stronger than ever. Now, we talked about the very strong clientele with cash, and we deal with those elite clientele all the time.
Yes.
But let's talk about the clients that may need to borrow up to 80 or 90%, like our legal clients who can borrow up to 90, and the medicos and accountants can do so as well. How important in the negotiation process is having your finance and pre-approval ready to go? Is it as important as people make out, or can it be a deal breaker for someone to have their pre-approval ready as to someone who says, I've got to chat to my broker?
I can tell you now, firstly, we wouldn't take on clients unless they were pre-approved.
Okay? There you go.
There's the first thing. Second thing, there are opportunities out there, and being able to execute quickly, it can be the difference. And if you're not pre-approved for finance, that means you cannot execute quickly. Okay.
No.
We had one recent example, cash buyer, property going to auction on Saturday. We bought it on Thursday, and we just turned up with a contract, a 66W for a cash buyer at a number that surprised me, right? And put it that way, because the vendor's motivations were to get onto another project.
Of course.
So they weren't, at the end of the day, I believe that, there was a real cost saving in the brief, and we bought really well. But also, if we weren't able to do our research, our due diligence, and execute quickly the way that we did, we wouldn't have bought it at that number. So if you're not pre-approved, can be a real deal breaker. But the other thing too, in this environment, I'm sure you're seeing this, you need a buffer, okay? So it's not just about the approval, it's also about having a buffer for a contingency for a rainy day, okay?
Of course. And our legal clients are the kind of people to do that. Many of them have spreadsheets up the yin yang of their Mojo account, if you've read the Barefoot Investor or what have you, of funds to look after that. But I want to just take back to what you said about the 66W, because a lot of my clients and a lot of people out there are very scared about signing them because it basically waives all the rights.
Yeah.
How do you use it strategically, a 66W, when someone is basically approved for finance subject to evaluation? What's your conversation to one of your clients about signing a 66W? Not financial advice, but when I bought my house here in Frenchs Forest, I signed a 66W because I wanted the edge. I saw the value in doing so. What would be your take on that?
Firstly, you've got to do your due diligence and your research before you even have the 66W discussion, right? So you don't sign a 66W and then do your research.
No.
Right? But I can tell you now, like, there's segments of the market or people out there that will just pressure buyers without doing the
sign. Yeah.
Yeah. So basically, for our point of view, that discussion doesn't even come into the arena unless we understand what we think the property is going to sell for. We've had a legal review. We've had strata reviews, or we've had pest and building. We've done all of that. We're fully aware of what the property's worth.
Yes.
We've got a loan pre-approval in place. So only that 66W only comes into the discussion after all the due diligence and ticks have happened.
Okay. Makes sense.
Yeah.
Makes sense. So
And
after you've done the checks and balances.
Yeah. So if you're doing it the other way, let me tell you, it's fraught with danger, because once a solicitor signs that 66W and says to everyone that you've been advised of the benefits and consequences, you could end up with a very different outcome. And if you're buying the property at a higher level than what the bank is going to value it at, then you're going to have a funding issue. Okay.
No, it's very true. It's very true. And
what we try and do.
Yeah, go ahead. Tell me.
Sorry. What we try and do is that, given our valuation backgrounds, what we try and do is that I believe we're within 2% of the market. Okay.
Yes.
And if you're a value or a bank value, being within 2% of the market is acceptable. Okay.
Yes.
What you don't want to be is 10% from the market. Okay. Because that's where you get. And in this market, there's valuation risk in the market, and I'm sure you're probably seeing that potentially
all the time.
Some of the deals that you're doing. So we try and de-risk it by doing what I call an estimated purchase price range.
Okay, so within that 2% mark, I think that's quite sensible. And talking anecdotally about that instance of people not doing their due diligence, I remember one of my colleagues in the buyer's agent world had a legal client engaged, paid the fee, and then was at the supermarket and ran into the real estate agent of one of the houses that the buyer's agent had briefed on. The real estate agent said, "Oh, no, don't worry about dealing with your buyer's agent. Come with me." Sign the 66W, and obviously cut their buyer's agent out, but ended up finding some defects in the property. And it's one of those things that when that real estate agent is pressuring you to do something, it's only till after you find it. And it can be heartbreaking when that kind of thing occurs. I always say to clients, it would be like me engaging you as my lawyer for a matter, and then when you were in the bathroom, going in front of the judge myself and representing myself, and then totally botching it. You don't want to do that. You want to leave it to the professionals.
Yeah, if you're a selling agent, your famous words are, sign a contract with a 66W. We hear that every day. Okay.
Oh, of course.
Right.
Absolutely.
Anyway, their job is to sell and to get the highest number possible. But, the obligation as a buyer's agent, we've got a duty of care.
Correct.
And, I don't like, we've never had to explain anything after the event in 7 years. And, so we do it the right way, to be honest with you.
I think so. And I guess teasing out that point about, obviously, real estate agents want to sell at the highest point. and buyers agents are advocates for the buyer themselves. When lawyers say, well, I'm engaging someone, how do I know that they're not going to try and increase the price because they get paid a higher fee? What's your argument? Because legal clients ask me that all the time.
Yeah, and look,
I'd love
it's
to
a
get
very,
your viewpoint on
it's a
that.
very valid comment. We charge fixed fees. Okay.
Okay.
So regardless of whether you bought the property at 900,000, 1 million, or 1.1, you'll know what the fee is up front. Okay.
Good.
I have a real issue, and it is out there with buyers agents that charge scaled fees. Okay.
Yes.
Basically, as a buyer's agent, I'm supposed to be buying the property for you at the lowest price possible, right? So why should I be incentivized to pay a higher number to get paid more?
It's a
Right?
good point.
Yeah,
Yes.
so I have a real issue with that. So in all of our briefs, it's been the same for 7 years. We have a fixed fee, and it's a fixed fee based on the property, the geography, and the brief, right? So we don't care what price point you buy it at. We're not going to get incentivized if you pay a higher number. Our obligation is to buy it at a level that is supported by the due diligence, right? And at a level where you're going to minimize any valuation risk that might happen if you appointed a bank valuer to value the property and you had a difference, right?
It's a good point. No, I think they're all very cogent insights you're making there, Michael. Because we've got a few viewers in talking about hotspots and opportunities in the market in an increasing rate market. What are you seeing right now as the biggest opportunities and hotspots?
I don't like the word hotspot, right?
Okay, well, cold spots.
No, I'll tell you where I'm coming from. Hotspot to me implies that you're going to get a lot of investors go into a suburb, drop a lot of money, right, and then all of a sudden, when it all hits the fan, they're going to run away very quickly. Okay.
Yes. Okay.
So for me, a hotspot is 20 kilometres from the Sydney CBD, right?
Interesting. Okay.
So basically, what I'm saying is that we try and keep our briefs within 20 k's of the CBD.
Okay.
It's in markets that are gentrifying. It's in markets that we believe there might be gaps in pricing. I'll give you an example. Dulwich Hill is going to be more expensive than Helston Park, as an example.
Of course.
So when Marrickville and Dulwich Hill get too expensive, buyers are looking for better value for money. Okay.
Of course.
And that might come in Canterbury, Ashbury, Helston Park. Okay. Just one example.
Yes.
So we're always following, we call those sister suburbs, for one of the words, right? So we're always trying to identify suburbs where we believe there's better value buying at that price point. But the fundamentals are, they've got to be, whether they're, especially if they're investment, right? Owner occupation has an emotional component, and people want to live in a certain area, which is very different. But when you're talking about investment, our criteria is 20 k's from the CBD, good incomes, low vacancy rate, good history of capital growth, good infrastructure, good resale history, and stuff that can be supported. Okay. So for us, if you follow that criteria, not only personally have I done well out of that, but also our clients have also done well following that criteria. Okay.
Well, we got some people that resonate with what you're saying. Mr. Edward Z, a marketing powerhouse, over 100,000 followers on LinkedIn, says, love it. So you're definitely getting some people that are resonating on that there, Michael. Look, we're getting into the final 5 minutes. What are the parting 3 biggest tips, if you like that word tip, maybe 3 biggest suggestions, recommendations you'd let people know watching now?
Yeah, look, first thing is that there's never been a better time to get specialised advice on property than what there is now, okay? And that advice needs to be independent, right?
Okay.
Second thing is research, and more research. So you've got to research never ends. It just continues. So you've got to understand the price point, the geography, the property type, and you've got to follow that. And you've got to go to auctions, whether you need a buyer's agent or not, doesn't matter. You've got to still go out there, understand where the market is, where the risks are, where the price points are, and the trends. Very important. And the third thing, we had a lot of people that entered the market up until about November last year because there was a fear of missing out. Okay.
The FOMO. Yes,
Yeah,
FOMO
the
is real.
FOMO. My suggestion is you don't invest in property unless you're ready to invest in property. So don't follow the herds or the crowds. Investing in property, what that means is go and talk to your financial planner, right? Go and talk to all these professionals need to be independent. Go and talk to your financial planner, talk to your accountant, talk to your mortgage broker or your lender. And then when they're giving you their comments, and when you're in a position to be able to invest, that's when you should invest in the market and don't follow the herds. Because part of the reason of this significant increase of over 30% over that 2-year time frame that we discussed, because people were entering into the market just to enter into the market rather than based on the logic or rationale as to why they should come in there.
That's a good point. That herd tribal mentality can be quite detrimental, especially in a rising rate market, but also a dropping rate market as what we saw in 2020, 2021. Don't want to use the word unprecedented, but that's what we were seeing, cheap money. And it was just driving. I think people are still trying to get themselves out of that mindset because I've got clients that are saying, I'm just going to wait till the right time. I go, what do you mean? What are you waiting for? Are you waiting for the media to say now it's time to buy when everyone starts to do it? What we're seeing is a record number of properties like dropping in price right now because prices, vendors are needing to sell because I think there was one in the AFR the other day, 20 grand loss. They bought 1 year ago. They took on the money too much. They had to drop it. So we're seeing those vendors having to temper their expectations, but also buyers having to realize that if they wait any longer, their borrowing power also drops as well. I've had a client that's been waiting since January. Their borrowing power was $1 million. Now it's 750 with all the rate rises. So there's a very real hindrance of time at the moment. Wouldn't you agree?
Yeah, I do. And it's any investment in property needs to be long term, not short term.
No,
unless you're more sophisticated. The average person is passive in their investment,
yes.
so you need to take a long term approach. As long as you get the basic criteria right, it doesn't matter when you buy, but you've always got to make sure that you're buying at that lower level of what that property's worth. Okay.
Love that.
Because the profit is in the buying, it's not in the selling. So we can't control the sales outcome. We can only control what we can buy the property for. Okay.
No. I love what you said there. For those that just tuned in or watching, the profit is in the buying, not in the selling. I think those are wise words from Michael and a great way to finish. Where can people find you, Michael? Where are you hanging out these days? Is it LinkedIn?
LinkedIn, Facebook, Instagram. As I say, Callum, give us 24 hours notice and we'll be client's property, client's house, at their business, chat over a coffee, whatever it is. Look, our philosophy is to try and educate people along the process. Okay. I've been around for a long time and, we've certainly seen different markets, but the market at the moment is complex. And
it is.
In my opinion, there's no better time than to get better advice than what there is now.
I love that message there, Michael. Thank you so much for tuning in and joining everyone. And Michael, really appreciate your time and how generous you've been.
Thanks, Callum. Thank you.
Thanks so much. And if you want to follow Michael, please, he's in the stream now. DM, follow, and shout out on this broadcast. We come every Wednesday on Wednesdays with Lawyer Lending Live. And please join us at 12:15 for a Law Live episode with Mr. David Gale, where he talks about family law and the future. Have a great Wednesday, everyone. Take care.